just as we saw a real acceleration and decline in demand as a result of the weakening economy, the very rapidly weakening economy after the Lehman Brothers bankruptcy in September of last year. We also saw a major ramp up in supplies as a result of this drilling boom in early 2008. So we saw a real jump in supply and decline in demand at the same time. Not really that surprising that that caused natural gas prices to remain quite weak. We're still seeing a lot of weakness in natural gas prices in the front month contracts. In other words, in futures contracts expiring between now and November. I believe that's due to jitters on the part of investors who are looking at the end of the summer injection season. In other words, after November, we start to move into the winter heating season, which is a key time of demand for natural gas. Typically, seasonally, natural gas inventories begin to drop after November. But investors are very worried between now and that, and when demand ramps up for the winter, that we'll actually see natural gas inventories in the United States reach their maximum totally full levels. And that's really put pressure on near-term natural gas prices. If we look at prices post-December, December futures contracts, and as we move into 2010, it's been a whole lot more stable than those near-month and spot natural gas prices. And what I believe that reflects is the likelihood that we're going to see a big tightening in the natural gas market as we move into next year. On the demand front, as I mentioned, manufacturing demand appears to be coming back. That's going to spell an uptick in industrial demand and a stabilization in the most important source of demand destruction in natural gas over the past year. On the supply side, just as producers ramped up drilling activity in early 2008 due to rising natural gas prices, as you can imagine, with natural gas prices so weak this year, they've really cut back on their drilling activity. The number of rigs actively drilling for natural gas in the United States is down more than 60% year over year, which is a record rate of decline. And that's across the board, everything from conventional natural gas production to production from some of these more prolific unconventional reserves I mentioned a moment ago. As a result, I think we'll also see sort of a reverse perfect storm in natural gas prices moving into 2010. Just as demand stabilizes and begins to recover, you could see production falling sharply. Some producers believe that production in the U.S. could be falling, could have fallen as much as 10 to 15% from its peak levels by sometime next spring. And that's a very rapid, almost unprecedented decline in production and should quickly balance the market and bring those inventories under control. So what do we look at in terms of playing oil and natural gas? On the oil front, one of my favorite sectors for a long time have been the oil services sector. Basically, if you look out around the world today, the types of fields that are being targeted are fields such as the deep water. Some of you may have heard of the recent discovery announced by British Petroleum BP in the deepwater Gulf of Mexico, the Tiber field. That field, the well that was used to drill that field is actually 7 miles long. It's a record depth, record length well. Drilling a well like that is very expensive and very technically complex. The companies that benefit most from increasing technical complexity would be your services firm. The traditional fields that we've used to power or meet most of the world's demand for oil have been these large onshore fields, which are relatively easy to drill and can be drilled using relatively simple technologies. For example, for many decades, most of the wells drilled in Saudi Arabia were simple vertical wells, and they were very, very prolific and produced lots of oil and very little water and impurities. Nowadays, that's just not the case. Producers are going after very complicated fields such as the deep water. They're also going into mature fields, fields that have already been drilled, and targeting smaller pockets of oil using technologies like horizontal drilling. The more complex a drilling operation, the more you need services companies to provide that technical know-how. One of my favorite services companies is Weatherford International, symbol is WFT. Weatherford has some of the very technically complex services, particularly related to the development of mature reserves, older fields again, where you're targeting smaller pockets of oil. They also have an excellent strategic position in two key oil-producing countries, Mexico and Russia. In Mexico, they have a number of integrated project management contracts. Basically what that means is that the national oil company in Mexico, Pemex, has contracted Weatherford to manage a number of wells being drilled in a particular field called Chicontepec. This is a very stable source of revenues and also quite profitable for Weatherford. In Russia, Weatherford recently acquired the oil services division of TNK BP, which is a joint venture between BP and the Russian oil producing companies to produce a number of key fields in Russia. This added dramatically to their strategic position there at a time when the Russian oil production sector is quite depressed. But with oil prices recovering, I expect that market to really pick up moving into next year, and Weatherford has a very enviable position there. As far as natural gas is concerned, there are really a couple ways to play it as well. On the services side, I would look at a company like Nabors, symbol NBR. This company is a contract driller, which means that it leases rigs used to drill primarily for natural gas, but also for oil. It specializes primarily in land rigs, rigs used to drill on land rather than rigs used to drill offshore. It also owns some of the most complex rigs available in the United States. In other words, the rigs that you need to drill a lot of these complex wells in these unconventional fields. They've obviously seen a real drop in their business as a result of the declining drilling activity. But I expect as natural gas prices stabilize and recover, they're going to see their business stabilize and recover. Also, they've been less affected than some of the other drilling firms because they tend to focus on higher quality rigs, which are more efficient for producers to use. Therefore, the rates they can charge for hiring out these rigs is a little bit higher. As far as producers are concerned, one of my favorites is EOG Resources, which is kind of both an oil and a natural gas play. EOG specializes in unconventional oil and natural gas fields, primarily in the US and Canada, though they also have some overseas operations. For example, they have an enviable position in the Barnett Shale, which is primarily a natural gas play. They also have a nice position in the Bakken Shale, North Dakota and Montana, which is an unconventional oil play. And this gives them a lot of operational flexibility. When oil prices are attractive, economically speaking, they can target growth in their oil-producing properties. When natural gas prices look attractive, they can put more capital work on the natural gas side. Obviously, this year, they've been focusing mainly on some of their oil plays, in particular the Bakken Shale, which I mentioned. They're drilling some very prolific wells, some of the most prolific wells ever drilled in the United States in many decades. They've also located an area which they have an almost lock hold on, which is the northern part of the Barnett Shale, located north of Fort Worth, Texas, on up to the Texas-Oklahoma border. There they found that wells produce a combination of natural gas and liquids, crude oil and natural gas liquids. And they've drilled some very prolific wells there, which are very heavy in oil on the oil side. So they've been able to grow their oil production by targeting those wells as well. And what we're probably going to see from them near term is oil production is going to be up on the order of 20 to 25% year over year. Natural gas production is actually going to be down because the economics of natural gas aren't quite as attractive. As we move into 2010, I do expect natural gas prices to recover. That would give them then an opportunity to shunt a little bit more capital towards natural gas production, basically targeting wherever the economics are most favorable. Thank you very much.